we do believe that APRA is ahead of all the other regulators in the world. Okay, now, by simplifying the capital structure stack of the bank regulator perspective, that they make things simpler, okay, potentially reduce compliance and regulatory costs going forward. And the proposal is that they want the bank to actually increase their equity base. Okay, what do I mean by that? You guys can Google it. It's the discussion paper is on the APRA official website under the media release page. It's probably one of the, in my personal career, probably one of the really well written discussion paper I've seen in many years. So they divide banks into two groups. Advanced means your big four plus Macquarie. Your standardized means other smaller regional banks like your BOQ, your Bendigo, etc. So as of today, okay, our big four and Macquarie are required to have 4.5% as common equity, tier 1 capital, okay, and plus additional buffer to make up the whole. This is the 3.751%. So what? Okay, I'm not going to go into the technicality of what those additional buffer are. So basically, the bank's basic tier 1 capital reserve ratio is 8.25%. Okay. And then since global financial crisis, they have been asked to top up additional 2% to bring them up to 10.25. And then this very pale green here, 1.5%, is the bank hybrids, is the additional tier 1. And then the 2%, the light purple here, 2% is the tier 2. So that makes up everything to be at 13.75%. So what they're proposing is that they want to move from this capital structure, you keep the same amount of capital reserve ratio, but get rid of this 1.5 by issuing more tier 2 bonds and also raise more equity. So it moves, I guess it touched on a lot of people's nerve about, are you proposing that, we now potentially risking, because there's no buffer from the subordinated bond investor to your equity holder, right? So are you saying that you are increase the risk for a subordinated bond holder? So this is the first argument. The second argument is, so the bank will be forced to issue more equity. They will be diluting shareholders' equity. So banks don't like it, brokers don't like it. There's a lot of people that put, I guess, don't look at it, in favor of the APRA's proposal. Now, having said that, we are not here to speculate how things might play out, because in the discussion paper, APRA has given market participants probably 2 to 3 months time to provide their feedback. So it's like probably by early point next year, they'll probably come out and say, look, this is what we decide to do. In our experience, it's unlikely a regulator will do a 180-degree turn from now to the next 2 to 3 months. It may happen if there's a change of government. And we all know there's no federal election in the next 2 to 3 months, right? So, we think that there may be some fine-tuning, okay? But I think that there's a very strong likelihood that we will see that the bank will gradually, in terms of change or adapt what the regulator is hoping to achieve. But having said that, APRA is ahead of the pack. I wouldn't say it's ahead of the pack. APRA put themselves out there, basically have made this proposal, which is now different to everyone else in the world. Okay, so the argument is, yes, you have simplified the capital structure of the bank, but are you actually making it safer, or are you actually induce more systematic risk by remove additional buffer in there? So there's a lot of questions, right? So I guess, but let's look at the facts. Okay, so we don't want to speculate too much in the future, but at the back of that announcement, this is basically all the live ones. The price of September the 9th, the 10th, the 11th, on the back of this announcement, apart from the ones that are about to mature or being called back, on average, they've all kind of the price went up 1 to 2%, because that people are taking that, have that anticipating that there will be less and less such instruments going to be issued out to the market. So yeah, so I guess that further in kind of the scarcity issue start to playing out in people's mind. So yes.
So on paper, if you hold the security, it looks good in your portfolio, but at some point you have to sell it, right? So when's the sweet spot to sell?
Yeah.
Who's going to buy it? That's what I'm asking.
Yeah. So again, we are there are a number of likely scenarios that, for example, if this type of instruments are being phased out, I guess the bank will still need to issue more tier 2 debt, right? But tier 2 debt right now are only available in the OTC, over-the-counter wholesale market. Okay, so they will benefit two group of people. One are fund managers. Okay, so because you can't buy them, on your CommSec account, right? You have to go through a fund manager that will have access to the wholesale market. And the second group of people, us. So as a bond broker, you can't use other brokers. You have to come to guys like us to get access to the wholesale OTC market, right? So we're cheering for it, but it may not be a good thing for investors, right? Okay, so to Harry's question, okay, now what actually happens? Well, I guess we don't actually have the yield or the spread analysis on this page, but what I think we might be able to show you perhaps is this. Well, this chart was actually probably about a month ago because we don't have the latest recording here. But what we wanted to show you is that even prior to the APRA announcement, this type of instruments has been widely used by not just retail investors, okay? But actually the biggest participants in this market are mainly the stockbrokers, okay? Shaw and Partners, for example. Okay, Evans and Partners, Altmanet, they have a very big contribution to this type of market, right? So every new issuance, they come in the about size about $1 billion, sometimes 1.25. If I look at Shaw and Partners alone, well, we obviously know the operator very well. The person who run the SMA portfolio is an old-time friend of mine. Every issuance they will participate minimum $100 million for it. So even Shaw and Partners, one group alone account for about 10% of every new issuance. They make a lot of money. Okay, so you have stockbrokers, wealth managers, and plus the retail investors that every time when there's a new issuance, they always get oversubscribed, right? So you look at it that the issuer collecting the bid for people apply for about $4 billion of amount they're looking to apply, but end up issuing about $1 billion. So it's always like 3 to 4 times oversubscribed. So when they start trading on the market, you will see that immediate jump. Now, obviously not a lot. We are not talking about things like some of those technology companies that where you double your money on day one, but typically you will see that all these instruments start trading at a premium 101, 102, and then the demand will continue. There's still a very strong demand out there in the market that where, for example, fund managers, there are a lot of very reputable fund managers largely using hybrid as their as part of their income strategy, right? Kulaba, Yara, Realm. I would say that most of the fixed income manager would have one strategy that using hybrid predominantly in their portfolio.